Warren Buffett's 10 Rules of Investing. Warren Buffett needs no introduction. He is a philanthropist, business leader, motivational speaker, and the chairman of Berkshire Hathaway, a multinational conglomerate valued in the billions. Buffett is highly respected by his peers and is known for his business acumen and ethical practices, earning him the title of the Oracle of Omaha. At 90 years old, he is considered one of the greatest, if not the greatest, investors of all time. His real-time net worth, which I last checked at $146.2 billion, suggests he may be worth even more now. Upon deeper exploration, I found that Buffett's investment portfolio includes some of the world's biggest companies. He has held and sold significant shares in companies such as Apple, American Express, Bank of America, Coca-Cola, and Kraft Heinz, among many others. Interestingly, Buffett developed his investor mentality at a young age. By the time he was 20, he had saved up about $10,000, which he invested in stocks. By 30, he was already a millionaire. Now, he is worth billions and can afford to donate a significant portion of his wealth to charity. What makes someone like Warren Buffett so successful in investing? How has he managed to achieve such substantial returns from various businesses? It boils down to personal discipline. Buffett is a man driven by principles. Let's call them rules. Here are 10 of his best rules for investing. Rule number 1. Never lose money. Warren Buffett may be seen as a brilliant investor, but that doesn't mean he's immune to poor investment decisions. He learned this lesson the hard way when Berkshire Hathaway lost $23 billion during the 2008 global financial crisis. This experience led him to develop 2 essential rules, which can be combined into one. Rule number 1. Never lose money. Rule no. 2. Don't forget rule number 1. Buffett advises that you should thoroughly research your investments and avoid treating them like a gamble. Protecting your wealth through informed financial decisions is crucial to not losing your hard-earned money. Rule number 2. Invest in something you understand. One of the biggest mistakes an investor can make is to invest in a business they do not understand. Buffett advises, never invest in a business you cannot understand. Successful investment requires an understanding of risks, target markets, and competition. Falling short in any of these areas can lead to significant challenges. Buffett states, risk comes from not knowing what you are doing, while unforeseen risks can arise. Recognizing potential challenges in advance allows you to evaluate whether they are manageable. Learning from experienced investors can help you make informed decisions. Rule number 3. Capitalize on dividend-paying stocks. Buffett's success is partly due to his focus on dividend stocks. For instance, Berkshire Hathaway receives substantial yearly dividends from companies like Coca-Cola. As the largest shareholder, Buffett benefits the most from these payouts. The key is to invest in reliable companies, as this increases the likelihood of receiving high dividends consistently. By identifying high dividend-paying stocks and holding on to them, you can secure greater payouts over time. Rule number 4. Reinvest your profits. While it can be tempting to spend your profits as soon as you earn them, intelligent investors like Buffett reinvest those profits. Spending your earnings can hinder your investment growth. Buffett learned this early in life by using the profits from his pinball machine business to establish a barbershop. He continued to invest his earnings in more pinball machines and additional businesses. The lesson is to use your profits to grow your investments and build more wealth. Rule number 5. Don't borrow to invest. Many people rush to borrow money from banks to invest in seemingly promising businesses. While this strategy can occasionally yield high returns, it can also lead to significant risks. Buffett advises against borrowing to invest, emphasizing the importance of using your own resources instead. Rule number 6. Learn. At 90-plus years old, not many seniors claim to read regularly, but Warren Buffett is not one of them. He starts his day by reading the newspapers to keep up with the latest business trends. Additionally, he reads financial books and other materials, continuously gaining wisdom with age. He consistently masters new business strategies despite being older and often spends time with savvy investors, exchanging ideas. According to the legendary stock investor, it's better to hang out with people who are better than you. Choose associates whose behavior is more admirable than yours, and you'll naturally drift in that direction. This is a valuable investment strategy for anyone looking to succeed on Wall Street. Focus on learning something new each day. Rule number 7. Think long-term. What I appreciate about Warren Buffett is his long-term perspective. He says, if you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. His long-term orientation explains much of his success. The Oracle of Omaha adheres to a buy-and-hold philosophy, believing in holding onto his investments until the market positions them favorably. This strategy has yielded significant returns over the years on major stocks like Apple and Coca-Cola. As he puts it, the stock market is designed to transfer money from the active to the patient. Rule number 8. Know when to walk away. While Buffett believes in the buy-and-hold strategy, he understands when to pull back. Holding onto a losing investment is rarely the right approach. Buffett learned this lesson during his youth when he would increase his bets at a horse race to recover his losses, only to lose even more. This taught him the importance of recognizing when it's time to let go. Similarly, in stock investing, if your stocks are consistently losing value, consider selling them and reallocating your funds to more promising opportunities. Consult experts and make informed decisions. Clinging to a continuously losing stock is not a wise investment strategy. You must know when to move on. Rule number 9. Differentiate value from price. Buffett states, price is what you pay. Value is what you get. During a financial crisis, many investors quickly sell off their stocks, but savvy investors like Buffett take the opposite approach. They use this time to gain a competitive advantage. They may hold on to their stocks or even buy more, waiting for better prices before selling high. It's crucial not to panic when a company's stock price drops. Instead, focus on its long-term value. Rule number 10. Diversification can be risky. While many believe in not putting all their eggs in one basket, which can be beneficial, Buffett argues that this strategy might hinder substantial gains. He advises, opportunities come in frequently. When it rains gold, put out the bucket, not the thimble. Regarding diversification, he claims, diversification is a protection against ignorance. It makes little sense for those who know what they are doing. Buffett believes that wide diversification is necessary only when investors lack understanding. Instead of diversifying excessively, he advises understanding a business thoroughly and then investing heavily. When a once-in-a-lifetime opportunity arises, seize it. You don't always need to diversify. Sometimes calculated risks are necessary. That's all for now. See you in the next video.